Understanding Kicking the Tires, a primer on investment research. Kicking the tires is a colloquial phrase often used in investment circles, signifying a preliminary approach to researching potential investment opportunities. While this method may serve as a useful starting point, it is essential for investors to recognize both its advantages and potential pitfalls to ensure they make informed decisions. What does kicking the tires entail? The term, kicking the tires, originates from the car shopping experience, where a prospective buyer might walk around a vehicle and lightly inspect its exterior, often kicking the tires as a superficial check of its condition, without delving into the mechanical components or performance history. In the context of investments, kicking the tires refers to conducting a minimal level of due diligence before deciding to invest. Common activities involved in kicking the tires. During the tire kicking process, an investor might engage in the following activities. Reading annual reports, a glance at the company's annual performance, including trends in revenue and expenses. Reviewing key metrics, evaluating basic financial ratios such as price-to-earnings, P/E, ratios and comparing them to competitors. Analyzing news headlines, scanning recent news articles to gauge public sentiment and recent developments concerning the company. Performing technical analysis, observing price charts and identifying possible trends without extensive research into market fundamentals. Broader investment context. Kicking the tires is applicable not just to stocks but also to various investment vehicles, including bonds, mutual funds, hedge funds, real estate, certificates of deposit, CDs, money market accounts. Examples of kicking the tires in action. To illustrate the concept further, consider these examples. 1. Hedge fund investment. An investor contemplating a hedge fund investment may begin by reading promotional materials from the fund manager without investigating the manager's history and any regulatory sanctions. 2. Certificates of deposit, CDs. Someone considering a 12-month CD might check general interest rates but neglect to read the detailed terms and conditions regarding penalties or restrictions on withdrawals. The benefits of kicking the tires. Kicking the tires can offer several advantages. Time efficiency. For investors pressed for time, initial assessments can yield quick insights that help filter out unworthy investments. Early exploration. This approach can sometimes lead to further, more profound investigations into promising opportunities. Accessibility. It simplifies the investment process for novice investors who may find extensive research overwhelming. Potential drawbacks of kicking the tires. Despite its benefits, relying solely on this method can lead to significant pitfalls. Incomplete information. Surface-level research may overlook critical factors such as a company's management quality, competitive risks, or industry trends. Misguided decisions. Investors may mistakenly perceive a company as a good investment based only on superficial metrics, leading to poor investments. Time misallocation. Frequently engaging in this cursory approach without a defined strategy can result in wasted efforts and missed opportunities. Best practices. Balancing cursory and in-depth research. To strike a balance between kicking the tires and conducting thorough analysis, investors should consider the following strategies. 1. Establish criteria. Implement a strict set of evaluation criteria to narrow potential investment candidates effectively instead of random assessments. 2. Preliminary screening. Use tire kicking as a first step, but plan to conduct in-depth research whenever a candidate appears promising. 3. Stay disciplined. Avoid the temptation to continuously explore new ideas without committing to detailed analysis on a select few. Conclusion. Kicking the tires serves as a valuable preliminary step in the investment research process. While it permits swift evaluations and can lead to potential opportunities, it is crucial for investors to comprehend its limitations. By recognizing when to deepen their analysis beyond the surface, investors can make informed and strategic decisions tailored to their financial goals. Balancing initial cursory assessments with detailed methodologies can enhance both the efficiency and effectiveness of investment strategies.